Brussels has rolled over the clock on Russia's sanctions again, and Moscow is warning Europe it will pay dearly soon. EU governments agreed this week to extend sweeping economic restrictions, keeping pressure on the Kremlin over Ukraine's war long running. It is a familiar 6-month renewal, but it lands amid fresh measures targeting oil shipping and money flows too. European leaders call the sanctions necessary, while Russian officials describe them as illegitimate, hostile, and ultimately self-defeating for all. Behind the headlines is a bigger question. Can Europe tighten the screws without splintering its own unity this winter either? And can Russia keep finding detours around restrictions as the EU moves from broad bans to detailed enforcement again today? For businesses, banks, and consumers, the answer will shape energy costs, trade routes, and the pace of diplomacy next year. The EU Council said on December 22nd that it renewed its economic sanctions on Russia until July 31st. Those measures cover trade, finance, energy, transport, technology, and dual-use goods, along with limits on luxury items exports, too. They also include bans on importing seaborne Russian crude and certain petroleum products into the European Union directly from Russia. Several Russian banks remain cut off from the SWIFT system, and some Kremlin-backed media outlets stay suspended inside Europe. EU officials say the goal is to deny Moscow revenue and components that could sustain its military campaign in Ukraine. The extension was adopted under rules requiring unanimity, meaning every member state had to sign off before the deadline hit. Renewals like this happen twice a year, and each time they test how solid Europe's consensus remains under strain now. Just days before that renewal, the EU added 41 more ships linked to Russia's shadow fleet to its lists. The Council said those vessels will face a ban on entering EU ports and on receiving maritime services from Europeans. By the EU's count, that brings the total number of sanctioned shadow fleet ships to nearly 600 overall now. European officials argue the fleet helps Moscow keep selling oil, often using opaque ownership and changing flags at sea regularly. The new listings are meant to raise the cost of moving Russian crude by restricting insurance, docking, and support services. Earlier in December, the EU also sanctioned individuals and entities it says enable that shipping network behind the scenes abroad. These steps sit alongside broader packages, showing how the sanctions have evolved from blunt tools into targeted squeezes over time. In October, the European Commission said the EU adopted a 19th sanctions package with tougher rules on energy exports again. That package set out a total ban on Russian LNG imports starting in January 2027 across Europe. It also expanded measures against the shadow fleet and targeted financial services, infrastructure, trade, and parts of crypto markets directly. Brussels argues these steps aim to cut off the cash that funds the war and to block sanctions evasion routes. Russia, for its part, says the West is weaponizing economics and punishing ordinary people on both sides without legal grounds. When sanctions lists grow, compliance departments scramble, shipping firms reroute, and exporters face sudden paperwork and delays at every border. That is why extensions matter, even when they look routine, because they keep all the underlying prohibitions alive for months. On December 17th, the European Parliament backed legislation to phase out Russian gas imports by late 2027 entirely. The vote was 500 in favor, 120 against, with 32 abstentions, as Reuters reported this week. The plan would halt Russian LNG imports by the end of 2026 and stop pipeline flows by September. EU ministers still need to give formal approval, but the same report said resistance is expected to be limited soon. To avoid a veto, the legislation uses voting rules that do not require unanimity, sidelining holdout capitals this time around. As of October 2025, Russian gas in the EU had dropped from 45% to 12%. Even so, some countries still buy Russian gas, keeping the debate alive about security, prices, and alternatives for industry today. The Council's renewal statement said the sanctions will stay as long as Russia's actions violate core rules of law international. It repeated the EU position that additional measures remain possible, signaling that pressure can still escalate if needed later on. That language matters because Moscow watches not only what is in force, But what could be coming next from Brussels? Europe's leaders also tie sanctions to wider support for Ukraine, including financial aid, military assistance, and diplomacy at scale today. At the same time, the EU must renew sanctions unanimously, giving leverage to governments that want exemptions or concessions often. That is why each renewal becomes a political negotiation, even when the final outcome is a simple yes from all. In recent cycles, concern has focused on Hungary, which has criticized sanctions and sometimes threatened to withhold agreement until late. From Moscow, the message is blunt. Russian officials say the EU is adding restrictions that have no legal basis anywhere. In an October Foreign Ministry statement responding to the latest EU package, Russia called the measures illegitimate under law international. The ministry argued that unilateral sanctions sidelined the United Nations Security Council, and it vowed retaliatory steps in response soon. Kremlin spokesman Dmitry Peskov has also said Russia has developed a degree of immunity and adapted to restrictions over time. That posture is meant to project resilience, yet it also underlines how sanctions have become a permanent feature of policy. Russian officials routinely say Europe is hurting itself, pointing to higher costs, lost markets, and strategic dependence shifts as proof. In Brussels, leaders counter that the costs are necessary and that easing pressure now would reward aggression in Europe too. So what do these extensions actually preserve? They keep the entire architecture of bans, caps, and exclusions in place today. For trade, the EU restricts exports of sensitive technology and dual-use items that can support weapons production inside Russia. For energy, it bans seaborne crude and some petroleum products, while also coordinating with partners on price limits where possible. For finance, it keeps multiple Russian banks disconnected from SWIFT, complicating cross-border payments and trade financing for many firms. For transport, it restricts aviation and now increasingly shipping, with port bans and service bans tied to listed vessels directly. For information space, the Council says it has suspended broadcasting activities and licenses of several Kremlin-backed outlets within EU. And importantly, new anti-circumvention rules try to stop intermediaries from rerouting restricted goods through third countries to Moscow quietly. The shadow fleet focus reflects one lesson from 3 years of war. Oil revenue is central to Russia's budget still. When Western buyers cut back, Moscow sells more to Asia, often at discounts, and relies on complex shipping chains now. Those chains can involve older tankers, frequent ship-to-ship transfers, and companies registered in distant jurisdictions for cover purposes. The EU says listing ships lets it deny them port access and services, limiting their ability to operate openly nearby. Services can include insurance, brokering, flagging, and technical support, and those are choke points many tankers need to move cargoes legally. But enforcement is a cat and mouse game because operators can rename ships, swap owners, and reroute voyages overnight sometimes. That is why the EU keeps updating the lists, adding vessels, and also people and firms that support them financially. Energy is the other front, where Europe wants to make dependence on Russia politically impossible as well as uneconomic soon. Since 2022, Europe has boosted LNG imports from the United States and other suppliers and expanded storage. It has also pushed renewables and efficiency, and it has tried to build new pipelines and interconnectors inside Europe rapidly. Still, the Reuters report noted that some members continue buying Russian gas, including countries in Central Europe, for now quietly. That is partly about geography and contracts, and partly about industries that need reliable fuel during cold months each year. The proposed phase-out law tries to end that debate by setting a calendar while giving time for replacements everywhere. Even if passed, the shift will be uneven, with some regions adapting quickly and others facing higher costs at first. Another recent move came on December 3rd, when the European Commission added Russia to its AML high-risk list form. The Commission said Russia has strategic deficiencies in anti-money laundering and counter-terrorist financing controls within its system today. Under EU rules, banks and other covered firms must apply enhanced vigilance to transactions involving high-risk jurisdictions like Russia. Brussels framed it as protecting the integrity of the EU financial system, not as a blanket ban on payments itself. Analysts note it could slow some legitimate commerce by adding checks, documentation, and compliance costs to routine dealings across Europe. For Moscow, it is another example of what Russia calls economic warfare, and it fits the Kremlin's public narrative exactly. For the EU, it is another layer of risk management, aimed at closing loopholes that sanctions alone cannot always seal. Even with these measures, Russia has continued to sell large volumes of oil, often at discounts to India and China. Reuters noted that Moscow has adapted to previous sanctions, building alternative routes and financing channels to keep exports moving abroad. That adaptability is why EU officials emphasize enforcement, because the hardest part is not writing rules, but making them bite. Some measures are straightforward, like import bans, but others depend on tracking ownership, paperwork, and hidden corporate ties carefully daily. That is why the EU adds names, vessels, and facilitators, hoping to create a web that is difficult to dodge. Still, every new restriction can trigger unintended effects, like higher freight rates or tighter credit for small traders elsewhere too. So the debate is not only moral and strategic, but also technical and economic. In a very real sense now, sanctions also reach into the financial battlefield of frozen assets, where Europe holds vast sums belonging to Russia's state abroad. EU leaders have kept about 210 billion euros of Russian central bank assets immobilized, largely held in Belgium. This month, EU leaders agreed on a 90 billion euro loan for Ukraine after a plan using assets stalled politically. According to the Associated Press, Belgium raised legal concerns, fearing retaliation, and the compromise avoided seizing the assets directly now. European officials say the frozen money could still help repay that loan later, if Russia does not pay reparations eventually. Russia has repeatedly warned that using its assets would cross a red line and would provoke countermeasures against Western property. The Financial Times reported Moscow has already frozen or seized at least $57 billion in Western assets there. That threat hangs over European companies still operating in Russia, from banks to manufacturers, who worry about sudden grabs today. The Financial Times said Russia's central bank has filed a lawsuit against Euroclear, the Belgian clearinghouse holding assets mostly there. Moscow has also talked about using so-called Type C accounts and other mechanisms to offset losses from sanctions imposed. Europe fears a cycle of escalation, where legal moves, asset freezes, and corporate exits feed on each other again fast. That is one reason some capitals hesitate to go further, even as others argue stronger action is overdue right now. The sanctions extension, then, is both a continuation and a signal that Europe is not backing down this year either. But it also shows the limits of consensus, because the boldest steps often depend on delicate legal judgments and timing. This week's renewal arrived alongside other EU sanction steps, including measures tied to human rights and hybrid activity in Russia. On December 22nd, the Council sanctioned 2 Russian judiciary members, citing repression of civil society and opposition figures there. Those listings impose asset freezes and travel bans inside the EU, and they bar EU citizens from making funds available. Earlier, on December 15th, the Council also announced sanctions against individuals and entities it linked to information manipulation campaigns online. That decision cited hybrid threats, including cyber attacks, reflecting a broader European view that the conflict is not only kinetic. Put together, the sanctions are now a layered system, mixing economic pressure, security measures, and targeted designations for specific actors. That breadth is also why Moscow calls the policy a siege, and why European leaders call it deterrence and defense. For companies, the practical reality is compliance. Every shipment, contract, or payment connected to Russia needs screening before it moves. That means checking lists, tracing owners, verifying end users, and documenting why a deal does not breach rules today either. In shipping, even a hint of sanctioned involvement can cause insurers to walk away, leaving cargo stranded or rerouted quickly. In banking, de-risked relationships can mean slower transfers, higher fees, and more frequent requests for supporting documents from clients. So the question for Europe is not only whether sanctions hurt Russia, but whether Europe can manage the blowback itself. Officials argue the system is getting smarter, targeting evasion networks instead of broad categories that catch innocent trade flows too. Critics respond that every extra layer adds friction, and that long sanction regimes can harden positions on both sides politically. Inside Russia, sanctions have reshaped trade patterns, pushing imports toward alternative suppliers and encouraging domestic substitution efforts over recent years. But substitution is uneven, especially for advanced electronics, machinery, and specialized components where global supply chains are hard to replace. Russian firms have used intermediaries and parallel imports, and EU says anti-circumvention measures aim to cut those channels. At the same time, Russia has leaned more on trade with China, India, Turkey, and other non-Western partners globally. That shift affects geopolitics because it deepens new dependencies and gives third countries more leverage over prices and terms a day. Europe, meanwhile, tries to convince those same countries to police re-exports, an effort that often runs into sovereignty concerns. So sanctions become a diplomatic campaign as much as an economic one, with pressure applied through talks and technical rules. Sanctions began in 2014 and expanded sharply after Russia's invasion of Ukraine in 2022 again. Since then, the EU has adopted repeated packages, and it renews core sectoral measures every 6 months by common procedure. Each renewal keeps restrictions active without rewriting the rules, and it buys time for new packages when needed later too. The December decision sets the next milestone at the end of July 2026, when the cycle repeats again. Between those dates, officials can still add new names, new bans, and new enforcement tools without waiting for renewal votes. That flexibility is why the Shadow Fleet updates arrived in December, even before the broader sectoral renewal was agreed formally. So for Moscow, pressure is constant, and for Europe, the challenge is sustaining attention and administrative capacity month after month. In its renewal statement, the Council reiterated support for Ukraine's sovereignty and said Russia must not prevail in this war. It also reaffirmed a commitment to a comprehensive and lasting peace based on the UN Charter and international law principles. European leaders repeat that no initiative about Ukraine should happen without Ukraine, a line meant to guard legitimacy in talks. Russia rejects that framing and says the West is prolonging the conflict, while Moscow pursues its objectives by force sometimes. Neither side shows signs of conceding quickly, which is why sanctions are treated less as leverage and more as containment. That shift in mindset helps explain why extensions draw little fanfare in Brussels, yet trigger loud denunciations in Moscow. Sanctions have become part of the baseline, like border controls or defense budgets, rather than a temporary punishment any longer. Against that backdrop, diplomacy still flickers, and Russian Deputy Foreign Minister Sergei Ryabkov was quoted discussing talks this week, too. State media quoted him describing slow progress in contacts involving U.S. envoys, while also saying Russia could legally pledge restraint. Such comments, even if cautious, matter because sanctions and negotiations interact, with each side looking for leverage before any deal. Europe's view is that pressure should continue until there is a change on the ground and credible security guarantees follow. So the renewal tells negotiators that Europe is not offering relief automatically, and that concessions would require real moves first. That may harden positions, but it can also set clearer expectations, which some diplomats say is necessary to avoid illusions. Looking ahead, European ministers are expected to finalize the gas phase-out law early next year, following Parliament approval vote. If it enters force, LNG would stop by end 2026 and gas would finish in 2027. Reuters also reported the Commission plans to propose legislation in 2026 to phase out Russian oil imports separately. That would add another long runway measure, reinforcing the idea that the relationship is being redesigned for years to come. On sanctions enforcement, Europe will likely keep expanding shadow fleet listings and tightening service bans when evasion emerges again soon. Russia will keep seeking alternative finance and logistics, and it will likely answer with its own lists and restrictions, too. For ordinary people, the effects are indirect but real, seen in prices, travel, jobs, and the shrinking space for exchange. Europe has largely replaced Russian pipeline gas, but the transition has required subsidies, infrastructure spending, and difficult choices for governments. Industries from chemicals to metals have faced higher energy bills, and some production has shifted to regions with cheaper power. And at the same time, Europe argues it has reduced a security vulnerability, cutting the leverage that Moscow once held over. Global oil markets have adjusted too, with different trade routes and more long-distance shipping, which can lift emissions overall. That is one reason regulators focus on the shadow fleet, because accidents, opaque insurance, and aging ships raise risk everywhere. For coastal states, the worry is spills and safety, and for insurers, the worry is paying claims and disputes later. So sanctions are entwined with environmental and maritime governance, not just geopolitics, even if that gets less attention on air. Another part of the pressure campaign is information, as Europe tries to limit what it calls disinformation and interference operations. The Council renewal notes suspensions of certain Kremlin-backed media broadcasting in the EU, a move Russia says is censorship. The December hybrid threat sanctions show that Brussels is expanding beyond economics, treating cyber and influence as fronts too now. Moscow denies wrongdoing and accuses European governments of propaganda, while it emphasizes its own security narratives for domestic audiences daily. In democratic societies, these claims compete in public view, and sanctions policy becomes a debate about speech and trust too. That is why officials try to explain sanctions in concrete terms, linking them to revenue, weapons, and war endurance metrics. Still, in many countries, voters mainly notice inflation and jobs, so leaders must keep making the case repeatedly at home. The Kremlin, meanwhile, uses the same hardships as proof that Europe is weak and divided, hoping doubt spreads further still. What should viewers watch next? First, whether EU unity holds through the next renewal in July 2026 again. Second, whether enforcement tightens further on shipping, with more vessel listings and stricter rules on services and insurance coverage limits. Third, whether the planned gas phase-out becomes law and how quickly member states can replace remaining Russian supplies fully. Fourth, whether financial controls like the high-risk AMN listing lead banks to cut exposure even beyond legal requirements voluntarily. And finally, whether diplomacy shows traction because sanctions can last for years, but wars can shift suddenly on one decision. If talks stall, Europe may add more packages, and Russia may deepen retaliatory measures against Western companies and assets inside. If talks advance, both sides will still argue over sequencing, because relief, security, and territory are tightly linked together now. For now, the EU has chosen continuity, extending sanctions and adding fresh restrictions to close gaps in shipping and finance. The Kremlin is denouncing the moves as unlawful and hostile, while insisting Russia can endure and adapt once again today. Europe says the opposite. That endurance is exactly the point, to keep pressure steady until aggression stops and peace holds. Between those narratives, the real story is a slow, grinding economic contest that touches ports, pipelines, courts, and banks daily. The next months will show whether tighter enforcement changes Russia's calculations, or whether both sides simply dig in deeper again. Either way, the sanctions clock is ticking toward July, and the political fight over costs and resolve is not ending.